Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Coinbase.
If you find our talks useful, please consider subscribe, like, and comment underneath. We're also doing a deep dive today into a fresh equity research report on Coinbase, ticker COIN from August 23, 2026. Oh, and real quick, there's a 14-day trial link for StockOracle down in the description. Just a quick affiliate disclosure there. And remember that AI insights or value estimates can sometimes be wrong, so always, verify them yourself.
Right. Always do your own homework, especially with a company like this that is just, well, it's sitting right at the intersection of crypto cycles and high-stakes Washington politics.
Yeah, and their own internal financial struggles, honestly. Because we want to focus on long-term wealth building here. We want to protect capital. And when I look at Coinbase right now, it's a bit of a paradox.
It really is.
I mean, imagine a company that just reported a $350 million net loss in a single quarter.
Yeah, brutal.
Trailing revenue is shrinking. The executives are just aggressively offloading tens of thousands of shares. And their cash pile actually shrank by over $2.5 billion in just 6 months.
Right, which sounds like a total disaster on paper.
Exactly. If you just looked at those numbers, you'd think, okay, this is a distressed asset. But then you look at the ticker, and the stock just rocketed nearly 24% in 5 days. It closed at 186.49. So what is going on here?
Well, there is just a massive disconnect right now between the rearview mirror and the windshield. The trailing financial reality is completely at odds with this sudden market momentum.
Which is exactly why we need to unpack this. Is this violent surge built on a durable shift in the business, or is it just, a temporary sugar high?
I think the best place to start is with the external triggers, right? The macro environment. Because you really can't talk about Coinbase without talking about Bitcoin.
Oh, absolutely. I mean, Bitcoin just broke above $79,000.
Which is massive.
Yeah, the report notes it was on track for a weekly gain of over 20%. That's its biggest weekly rally since all the way back in 2023. But it wasn't just organic retail buying, right? It was a real cocktail of catalysts.
Exactly. The research breaks down the mechanics. You've got short squeezes, you've got ETF flows, and Treasury bond buyback news all hitting at once.
Let's break that down a little, because a short squeeze always adds so much fuel to the fire.
Right. So a short squeeze happens when traders bet against Bitcoin. They borrow it, sell it, and hope to buy it back cheaper later.
But then the price spikes unexpectedly.
Yeah, and they panic. They are forced to buy Bitcoin at these higher prices just to cover their losing bets. And that forced buying pushes the price up even more. It's like pouring gasoline on a fire.
And while that mechanical squeeze is happening, you also have the structural capital flowing in, like the ETF flows.
Which is sticky money. Institutional money managers now have a regulated way to just buy Bitcoin through normal brokerages. They don't have to mess with crypto wallets.
Right, which creates this persistent buying pressure. And then you add in the Treasury bond buybacks. I mean, that is traditional finance just spilling right over into crypto.
Yeah, because if the government is buying back its own debt, they're taking bonds out of the market and injecting raw cash into the system. And capital is like water. It flows toward the highest potential yield.
And right now, Bitcoin is acting like a sponge for that new liquidity, being such a sensitive risk asset.
Exactly. So that's the financial plumbing. But we also have to talk about Washington, D.C., because they just provided a huge psychological catalyst.
Oh, the political pivot. It's like the regulatory weather forecast just changed overnight from a Category 5 hurricane warning to clear, sunny skies.
It really did.
I mean, President Trump hosted a White House crypto summit. He reiterated this commitment to keeping the U.S. as a leader in digital assets. And he's pushing Congress for the Clarity Act.
Right, and even discussed a potential sovereign Bitcoin purchase. Which is wild to think about.
Yeah, the U.S. government holding Bitcoin as a strategic reserve asset. And Brian Armstrong, the CEO of Coinbase, was sitting right there in the room. So I have to ask, how much of this stock jump is just riding the Bitcoin wave versus a real structural change?
What's fascinating here is why this regulatory normalization actually matters for their business. For years, the biggest overhang on Coinbase has been regulatory ambiguity.
Right, the SEC lawsuits and all that.
Exactly. They've been operating under this cloud. But the Clarity Act isn't just symbolic. It would provide clear statutory rules for how digital assets are traded in the U.S.
Which changes who can actually participate. Because, I mean, a massive state pension fund isn't going to touch a crypto exchange if they think the SEC might sue them tomorrow.
They physically can't. Their compliance mandates prohibit it. So if the Clarity Act passes, that legal risk discount just evaporates. It unlocks this massive tranche of institutional capital that's been waiting on the sideline.
Waiting for permission.
Yes. And Coinbase is positioned as the primary on-ramp for all that capital.
Okay, so the macro environment is incredibly sunny. But as someone focused on protecting capital, I always say a rising tide only matters if your ship doesn't have holes in it.
Fair point.
And when we look at the actual fundamentals in this report, it's a tale of two realities. The bad news is really bad. Q2 2026, they showed a $359.5 million net loss.
Which is a hefty deficit for one quarter.
And it's not a blip. First half of 2026, revenue dropped about 25.5% year over year. They swung from a $1.49 billion profit in the first half of 2025 to a $753 million loss in 2026.
The trailing metrics are definitely grim.
But then, and this is where I need you to help me connect the dots, they have an 86.35% gross margin. They have 14 consecutive quarters of positive adjusted EBITDA. And they just hit a record 10.3% trading market share.
Yeah, it's a weird mix of numbers.
Wait, if they're capturing a record 10.3% slice of the entire trading pie and they boast an 86% gross margin, why are they swinging to a massive net loss?
If we connect this to the bigger picture, it comes down to operating leverage and high fixed costs. Think of Coinbase like a massive state-of-the-art toll bridge.
A toll bridge.
Right. Building and maintaining that bridge, the cybersecurity, the compliance teams, the servers, it costs an absolute fortune. And those costs are fixed. You pay them whether Bitcoin is at 20,000 or 79,000.
So during a crypto winter, when retail gets bored, the bridge is totally empty.
Exactly. But the maintenance bill doesn't change. That revenue shortfall drops straight to the bottom line, causing that massive net loss.
But then that 86% gross margin.
Yes, that is the most important number. Gross margin just tells us the direct cost of facilitating one more trade.
Because it costs them almost nothing to let one extra car drive over the bridge once it's already built.
Exactly. Once those massive fixed costs are covered, almost all the new revenue from extra volume falls straight to the bottom line as pure profit. So when the cycle turns and retail FOMO kicks in, the toll bridge floods with traffic. They don't need to double their staff. Revenue skyrockets, costs stay flat, and they swing back to profitability.
The report mentions they have a beta of 3.43, meaning they are insanely sensitive to crypto volume.
Yeah, they have a massive competitive moat, but it is an incredibly volatile way to run a business.
Which brings us to their long-term growth drivers.
Yeah.
Because relying on Bitcoin price swings is just boom and bust. Management has to be trying to diversify.
They are. The report calls it their everything exchange strategy. They're dividing this into an existing engine, an emerging engine, and then future optionality.
Let's talk about the emerging engine first, subscriptions.
Right. Products like Coinbase One. It's recurring subscription revenue. You pay a flat fee for zero trading fees and better staking rewards. Kind of like Amazon Prime for crypto.
I like that from a wealth building perspective. Predictable monthly cash flow dampens that crazy cyclicality.
And Wall Street loves it too. A pure transaction exchange gets a low valuation multiple, but recurring revenue multiple expands the stock.
Okay, but here's where it gets really interesting. The report outlines a massive international play for their future optionality. They just secured a financial services permission in Abu Dhabi.
Yes, in the ADGM, to build a regulated international tokenization hub.
Tokenizing real-world assets. So taking a commercial skyscraper or a treasury bond and representing it as a digital token on a blockchain.
Exactly. And the reason that matters is settlement time. A traditional trade takes 2 days and tons of intermediaries. A tokenized trade settles instantly, 247 with almost no fees.
Tokenizing real-world assets in Abu Dhabi sounds like great optionality. But right now, aren't they still entirely at the mercy of Bitcoin's price swings?
They absolutely are today. The Abu Dhabi hub is early-stage optionality. It's a multiple expander for the future, maybe 2030, but it's not paying the server bills right now.
Right. And that means we have to look at the red flags, the stuff that could derail this whole thesis. And honestly, the insider trading data in this report is a glaring warning sign.
It's stark. 46 open market sales by insiders, totaling over 59,000 shares.
And 0 open market purchases, none. If the political winds are shifting in their favor and they're capturing record market share, why are the insiders apparently heading for the lifeboats? 46 sales and 0 buys feels like a heavy lean against their own stock.
This raises an important question about how we interpret insider flow. To be fair, executives sell stock routinely to pay taxes or diversify, often through 10d5-1 trust plans.
Right, those are scheduled months in advance, so a sale isn't always a panic button.
Exactly, but the sheer lack of buying conviction is what tempers the euphoria. The management sentiment percentile rank, the MSPR, is at -100.
Literally rock bottom.
Yeah, it suggests that while executives might believe in the 5-year vision, they aren't exactly pounding the table to buy the stock at these specific prices.
And the cash burn is the other massive red flag. Cash dropped by about $2.67 billion in 6 months.
That is a very steep drawdown.
Now, they still have an $8.6 billion fortress of cash against $5.9 billion in long-term debt, so it's not a liquidity crisis today. But as a cautious investor, burning $2.6 billion in half a year really erodes that narrative of self-funded growth.
You also have to watch the strategic risks. The report notes some competitive tension in their Circle partnership for the USDC stablecoin,
Which has been a huge revenue driver for them in a high interest rate environment. If Circle demands a bigger cut, that hurts.
It's a direct threat to their revenue diversification, yeah.
So we've got this insane tug of war, massive macro tailwinds, but bleeding cash and zero insider buying. So what does this all mean? What is the actual verdict here?
Well, technically, the stock is overbought short-term. The RSI is sitting at 74.83.
So a pullback wouldn't be surprising after a 24% run?
Right. But zooming out, it's still about 54% below its 52-week high of $402. The market has priced in the near-term Bitcoin rally, but it hasn't priced in a multi-year repair of the business.
Which is why the report gives it a neutral rating, a 6 out of 10.
Exactly. The analysts are saying they need proof. They want to see that this surge in activity actually turns into durable transaction revenue and returning profits. Momentum isn't enough.
So for our listeners, the immediate catalyst to watch is the Q3 2026 earnings report.
Yes, Q3 is the moment of truth. It will capture this August breakout and prove if the toll bridge is actually collecting cash again.
Okay, before we wrap, we have to touch on the 3 to 5 year blue sky scenario. This is the optimistic case, not a prediction. But if everything goes right, what does this company look like?
If the Clarity Act passes, ETF flows persist, they hold their market share, and that tokenization hub matures. Coinbase completely sheds its identity as a volatile crypto casino.
It transitions into a globally regulated platform. High recurring revenue, jet profitability, durable cash flow.
And Wall Street would completely revalue them. They'd trade like premium global financial infrastructure instead of a high beta transaction engine.
Which leads me to this final provocative thought for you all to mull over. If regulatory clarity actually happens and crypto is fully normalized, doesn't everything exchange like Coinbase eventually become indistinguishable from a traditional Wall Street bank? Or, with their tech advantage, do they just replace them entirely?
That is the multi-billion-dollar question for this whole sector.
It really is. All right, to summarize our wealth-building verdict today, the strongest long-term driver is their pivot to an everything exchange with recurring revenue and tokenization. The biggest threat is their massive cash burn and cyclical transaction reliance. The base case gives this a neutral rating, waiting for Q3 earnings proof. And the blue sky case sees them becoming the premium regulated plumbing for global finance.
Well said.
Thanks. Remember to check out the StockOracle 14-day trial link in the description, with the caveat that AI insights should always be independently verified. Thank you for joining us on this deep dive into Coinbase. Keep questioning the consensus, and we will see you on the next one.